Is a gold ETF as safe as physical gold? A gold ETF should be as safe or safer as physical gold. The gold is stored securely by those specializing in the industry and insured in case something happens. Exiting the investment is also easier as shares can be sold quickly on an exchange. What are the downsides of physical gold and gold ETFs? The biggest downside of physical gold is that you need to think about storage and insurance, find a buyer, and then send it to them when you want to sell. With ETFs, many of these tasks are taken care of for you. Downsides of gold ETFs include exposure to counterparty risk, annual fees, and the possibility the fund fails to properly track the price of gold. Another drawback is that you don't physically own the gold. Are there environmental or ethical considerations when investing in physical gold versus gold funds? Like diamonds, gold has come under scrutiny for where it's sourced and the conditions left in the wake of mining operations. The mining and extraction of physical gold can have significant environmental impacts and may involve ethical concerns related to labor practices, ecological damage, and who benefits from profits in the mine. Gold funds that invest in mining companies may indirectly contribute to these issues. However, some gold funds focus on sustainable and ethically responsible mining practices, offering investors the chance to support better industry standards. Investors concerned about these issues can research fund policies and practices related to environmental and social governance criteria, available on many brokerage websites. What are other ways to invest in gold? Yes, gold funds can provide exposure to various gold-related investments, not just the price of physical gold. For example, some gold funds invest in the stocks of gold mining companies, gold futures contracts, or a combination of physical gold and gold-related financial instruments. This diversification can provide broader exposure to the gold market and different potential sources of returns than owning physical gold alone. What are the tax implications of owning physical gold versus gold funds? The tax treatment of physical gold and gold funds can differ significantly. Physical gold is usually subject to capital gains tax when sold at a profit, and the specific tax rate may depend on how long you've held the asset, a year being the threshold for long-term capital gains. 0.25 Gold funds, especially those that invest in gold mining stocks or other securities, might be treated as regular investments for tax purposes, potentially offering different rates or tax advantages depending on the fund structure and your tax situation. It's important to consult with a tax professional to understand the implications of your circumstances. The bottom line: there are differences between investing in physical gold and gold ETFs that go beyond one being physical metal and the other being tradable shares. Nevertheless, a major advantage of gold funds is their generally higher liquidity because they can be bought and sold instantly on the stock market during trading hours. In contrast, selling physical gold requires finding a buyer and may involve authentication processes, which can take longer. Inverse and leveraged ETNs are more complex than gold ETFs. They track daily gold price changes by going in the opposite direction or magnifying price moves. Leveraged and inverse ETNs are not meant to track long-term gold price changes. While the expense ratio of ETFs can erode the amount of gold each share represents, they are often more cost-effective than buying and storing physical gold.